Yeah, hello and welcome back to my channel. This is another exercise case, as you probably have expected already. It will be a rather complicated one, so let's not hesitate too long. So let's just begin. This is now the entrepreneur I from Ingolstadt in Germany, and I get an order from a customer from Spain. That customer wants a custom-made production machine. So the customer is evidently also an entrepreneur, because only entrepreneurs seem to have need for a production machine. I's firm now only produces a standard version, but the customer has special wishes. What can one do? I want to do the wants to get the contract, and I knows a firm in Belgium which can make the necessary changes to turn the standard machine into the custom-made machine which the Spanish customer S desires, or customer C desires, whatever you call him. So I accept the order for an amount of 250,000 euro, produces a standard version of the machine, sends it from Ingolstadt to Brussels in Belgium, where it is transformed on the order of I and paid by I into the machine which S needs. Then, after it has been finished, the Belgian entrepreneur B sends, on behalf of I, the finished machine to customer S, and the standard version of the machine has a usual market value of 220,000. And how is that transaction to be treated? And additionally, let's add some information. B from Belgium. What did he do? He had to add certain important parts to the machine and made some changes to other parts, so working and some spare parts or additional parts. That all was one single transaction. I wanted to get all that things done from one contractor, one counterpart, so it was a unitary transaction, not several ones. And in total, that works costs of 30,000, which B charged to I from Ingolstadt. On the invoice, B treated the transaction as intra-community delivery and charged the amount free of tax to I from Ingolstadt. The question is if that was correct. And the answer is, well, nobody knows, so we must find out everything. Probably what we need to find out is simply the truth, the complete truth, and nothing than the truth about this case. So let's begin. As always, we should first try to analyze what happens. Now, this is a good deal of things. So the first thing which comes to our eyes is that I from Ingolstadt sells something to a customer S in Spain. It's a machine, it's a custom-made machine. The machine ends up in Spain. However, this particular machine does not exist before it has been produced, and the custom-made machine which the customer ordered doesn't exist before it is at Brussels. Only after the works in Brussels have been done, this machine which the customer has ordered exists. So the transfer of the machine towards the customer cannot begin before Brussels. So that's the first thing we can find out. Then that also implies from Brussels to Spain that this good crosses an EU internal border. So we will have to apply the rules for EU internal deliveries on that transaction. Then there is B from Belgium. B has a contract with I from Ingolstadt, has to add some parts to the initial version of the machine. Here are some parts, and only afterwards that machine exists, which the customer has ordered, the Spanish customer. This work happens at Brussels, and these parts become part of the finished machine in Brussels, so one can hold the view that the final destination is inside that machine, and so that the final destination of these parts is Brussels. However, there is something else which you don't see initially, because we have now the standard machine, the initial one, which belongs to I in Ingolstadt, before and after. It is first in Ingolstadt, but then transported to Brussels, and it never comes back. So one will have to explain what happened to this standard machine. It crossed the border internally within the EU, and for things like that, there is also a fictitious transaction, a so-called transfer of goods, intra-community transfer of goods. That was one of the special rules for EU internal transactions, which you perhaps remember. And here it shows up. So if we look to the sequence in which these events happen, first we have the transfer of the standard machine from Ingolstadt to Brussels. Then we have the work done in Belgium, and then the finished machine is transported and delivered from Brussels to Spain. So three important different transactions. And not to forget that the value of the machine which is transported from Ingolstadt to Brussels, the standard version is 220,000. So, how do we deal with that case? Now, probably we should just begin as the beginning, as always. So let's talk about event number one. So you see here that a standard machine is transferred from one state of the EU, namely Germany, to Belgium without change of ownership. That is a special case for which special rules exist. The inter-community transfer of a good is, you remember probably, to be treated as if it were an inter-community delivery of a good from the country where it comes from to the same owner in the other country where it goes to. This sounds a bit complicated because why do you have to declare something like that and tax it in the country where it goes to? First, the idea is that, let's say, to Brussels, Belgium, no goods come which, at least no goods for enterprises come which have not been taxed under Belgian law. But the far higher importance is if somebody owns a standard machine in Germany and this machine is no longer there later, then a tax inspection will just suppose it has been sold because it has not been destroyed. There would be proofs for that, and it has not been stolen. So probably it has been sold. And now you could say, no, it was not sold. I transferred it to another EU member state. However, you don't have proofs for that. So saying I brought something to an EU member state would be a good escape from all, or a good explanation for all things where goods vanished untaxed. In order to close that loophole, one obliges you to say, when I say I brought something to another member state, then I must be able to show that I declared that transfer, so that when this went out of the books in Germany tax-free, you had to show it at the same time in your books in Brussels, so that now the Belgian authorities know that you owned that good and that it was in Brussels. So if it vanishes later from Brussels, then you have a problem with the Belgian tax authorities. And so the main idea behind that transfer of good mechanism is that a good cannot be brought from one member state to another without, or cannot leave the books untaxed here in Germany without ending up in the books in another member state. So that there it cannot vanish again untaxed into consume, or can not come back undetected to Germany or things like that. So the whole thing is mainly for tax supervision. However, it's highly important. Yeah, that was the idea beyond or behind that rule. However, in an inter-community transfer of a good, you cannot take the consideration as tax base because one and the same owner can pay to himself no price, so you need a replacement or a default tax base, and that's the minimum tax base defined in 10.4 USDG, which always applies if the regular tax base in 10.1 cannot be properly applied or makes no sense. So knowing this, we can then go on and look for the transaction solution for number 1. The first aspect is the treatment in Germany, so on the supplier side. What is the taxability? Test 11 number 1. And this is not a genuine delivery because the position of an owner does not change. We have the same owner before and behind the border. However, it's deemed to be a fictitious delivery. So for the tax, it has to be treated as if it were a delivery, because when a good goes from one EU country into the other and stays there not only temporarily, then this has to be qualified as if it were a delivery for consideration. In the German text, you can see that in paragraph 3, 1a USDG, and it is probably a good idea to have a look on that rule just to get familiar with it. So we have 3.1a indeed here on our screen. As a delivery of a good for consideration will be regarded. So the first thing which you can see here, this is a rule which is only meant for things which are not actually a delivery. You need to regard it or deem it to be one. The transfer of a good belonging to the enterprise from the inland into the other parts of the community customs territory too, so to the VAT inland of any other EU state, by the entrepreneur for his own use, except for a transfer which is only temporary. Only a temporary transfer, that is something where the good goes to the other member state and usually later comes back. There is in the application decrees for the Umsatzsteuergesetz, so the value-added tax law, there is a list and an explanation which events the administration does not regard as long-lasting enough, so as only temporary. In the EU directive, they are even listed in full. The entrepreneur is then regarded as the vendor, and that's it. Now the tragedy goes on. We need to determine if it happened in the inland. That is to be suspected. The place of delivery is according to the basic rule where the transport of the good which has to be delivered begins. That is in our case of that fictitious transfer, Ingolstadt, or fictitious delivery, sorry, the transfer is real. That's Ingolstadt 3.6 sentence 1, so that would be in the inland. Is it for consideration, the delivery? Well, usually it is not if you look to the facts. However, that fiction in paragraph 3.1 USDG says the event is deemed to be a delivery for consideration. So also for consideration is fulfilled by fiction. And well, it's done by an entrepreneur. That's I from Ingolstadt. And within the scope of the enterprise, naturally, it's a business or an enterprise asset. So it's taxable under German law. Is there any exemption? And now you must know that an intra-community delivery in the sense of 3A1, 3.1a, sorry, is automatically classified as an intra-community delivery, so always by definition already it's tax-free. That is stated in 6a paragraph 2, so in a very special rule. There is no debate about this. The only thing which we should do is make sure that I don't telling you rubbish, but that it's true, and so we should look it up in the text of the Tax Act. So here you have that clear and undebatable statement which we need. As an intra-community delivery is also regarded, so a fiction, no debate, an intra-community transfer of a good which is deemed to be a delivery under 3 paragraph 1a. So that is, by the way, necessary because if you go to the first paragraph of 6a, then there would be something like the good crosses a border in the course of a delivery. There could be a debate if that must be a genuine delivery and things like that. And so all these debates are cut off by the special rule for intra-community deliveries, which is here in paragraph 6a, subparagraph 2. So everything's fine. No debate, there is a tax exemption guaranteed. So let's continue. So we are sure that our transaction is automatically tax-free as an inter-community delivery, because that inter-community deliveries are tax-free can be found in paragraph 4, number 1, letter B. However, there's the condition posed that the tax exemption is only granted if the supplier has correctly fulfilled his obligations to hand in a recapitulative statement where the tax base is named and the VAT number of the recipient, that's here the entrepreneur himself, from the other country, the destination country, so here from Belgium. The tax base, well, there is no net amount paid here because one and the same person cannot pay a payment to himself or herself. So by default, we have to go to 10.4. There, number 1 will apply the purchase price at the time of the turnover, so of the present event. And that seems to be that here the market price, and that is what is meant, is 220,000. We do not have any other information. So that, however, that might be debated. Usually under the German law, the correct value would be the price for which the German entrepreneur would be able to rebuy the good in question, so the standard machine, at the present moment. EU directive says normal value, that means market value. However, the tax rate and tax is not relevant because it's tax-free. The tax payment in that case, or the tax obligations, have to be fulfilled by the taxpayer. That's I from Ingolstadt. So he's responsible for the tax declaration under 13a, subparagraph 1, number 1, the arisal of the tax or tax point. So when does it have to be declared is at the end of the preliminary declaration period during which the delivery was made. Pro forma, there has to be written an invoice from himself to himself stating the VAT identification numbers of both countries of his and giving the net amount just for bookkeeping purposes. Declaration duties are the usual ones. You have to name it in your tax declaration. The recapitulative statement must be made automatically, and in spite of the tax exempt output, which we have here, I from Ingolstadt keeps all the input taxes for raw materials and all the like, because when you have any input combined or connected with an intra-community delivery, then in spite of the tax exemption, you know that the input tax claim remains in force. Okay, so now we have the first part of the first transaction. Let's now turn to the other side, the treatment in Belgium. Here we have to test the intra-community acquisition. And again, this should be placed out of any debate by the legislator. So indeed, we have here a rule which says an intra-community transfer of a good is always deemed to be an intra-community acquisition for consideration in the country of destination. In German law, you can find that in paragraph 1a, subparagraph 2 USDG. So best to check that. If we are correct here, we have a look into the Tax Act. And as you see here, paragraph 1a2, inter-community acquisition of goods, the intra-community transfer of a good from the other parts of the community customs area into the inland is deemed to be an intra-community acquisition of a good, and naturally the same rule also exists in the laws of other EU states, naturally, then defined from their perspective. So that's it. By the way, again, here the reason is that the basic definition of intra-community acquisition speaks of a delivery of a good, and that could be disputed if the delivery is only a fiction. So to make things clear, we have 1A2, which says, yeah, the intra-community transfer of a good is always an intra-community acquisition. And by the way, just to make the overview complete, the acquisition threshold for so-called half entrepreneurs is relevant as for genuine intra-community acquisitions, in the same way as for these inter-community transfers, so qualifies for both. Well, so let's go on. The place of acquisition is still to be determined. That follows from the usual rule 3D sentence 1, where the good is at the end of the transport, and that's here Belgium, Brussels to be precise. So it's a taxable inter-community acquisition in Belgium. Is there a tax exemption? Here you must remember first that the tax exemptions for acquisitions are not in paragraph 4 but in 4b. The second thing is that normally there is no exemption at all because there are only 4 cases relevant. However, there is one of the 4 cases, exemptions, where an exemption is granted for goods which are directly re-exported into another member state and therefore entitled to the application of 15.3 number 1. That's 4b number 4, and to make that sure, we will have a look on that. And again, and indeed, here it is, the list of exemptions under paragraph 4b, where an inter-community acquisition can be treated as tax-free. Number 1, number 2, number 3, not relevant, but number 4, the intra-community acquisition of goods is tax-free of those goods which are used for tax-free transactions for which the exclusion from the deductibility of input tax is not applicable, according to 15.3 USDG, and in plain words that means if the goods are goods which are after the acquisition into that state, directly re-exported to a third country or to another member state of the EU. So it's tax-free in Belgium, and the tax base is only for declaration purposes. 10.4 number 1, here it's supposed to 220,000 euro. The tax rate and tax is none because it's free of tax. See above. You should, by the way, keep in mind that a tax exemption like this for an inter-community acquisition is extremely rare. Normally, inter-community acquisitions are always liable to tax. So this is just a rare example. It just happened without any purpose. So, because that guy from Ingolstadt here had the tendency to confuse everything and make everything complicated. The taxpayer, so the guy who has to declare in Belgium, is the fictitious buyer I from Ingolstadt. The rest of formalities has to be determined according to Belgian law, so let's make it short and brutal here. Nothing peculiar shows up, at least not what we could detect. Input tax deduction is none here because the acquisition tax is not due, so we can't deduct it. However, if you had ignored 4b number 4 and had declared acquisition tax as if it were due to tax, then you would probably get away with it because, for example, at least the German administration has a binding directive got from the ministry which says if somebody ignores 4b number 4 and erroneously declares acquisition tax and then claims it back as input tax, one should not make a fuss about it because it has no effective consequences on the real outcome of the tax. Well, now that was event number one, and you probably know what comes after event number one. That's event number two, but well, no but, just let's do it. So, event number two, Belgian supplier delivers some additional parts and fixes them to the machine. So some parts change the owner and some work is done, and it's a single transaction. Now, you remember probably that if during any transaction a tangible good changes ownership, then this whole transaction is automatically classified as a delivery, apart from the case when these tangible goods are so unimportant for the contract in question that they do not count. However, in our case description, some material important parts had to be fixed to the machine, so they are not unimportant for the contract, so it's a delivery. Now we have to ask if the goods delivered by the Belgian supplier are moved during the delivery. And we have two questions, or two alternatives better. It's either no movement because the destination of the parts is in or at the machine. So when they arrive at their place of destination, when they are fixed to the machine, then that's it. So there is no further movement of the goods. They arrived at their place of destination. Or you could take the view that the destination is Spain, because after the goods have been fixed to the machine, they are transported together with the machine to Spain. And so that's possibly, these are two possible ideas how to see it. My own tentative solution is to say, well, when we fix the parts to the machine, then they cease to be independent objects. They are no longer existing under civil laws. They become a part of the machine, at least under the civil law codes of Germany. So one might take the view, based on that argument, that it's not possible to send the goods in question to Spain, but only the finished machine. And so the idea would be that probably the view that the place of destination of the goods delivered here is the machine itself, so in Brussels, that this view of the matter is better. In that case, the parts would be delivered without movement. And if that's the correct approach, then the solution of event 2 is the following one. Taxability should be tested number one. The Belgian entrepreneur does work and transfers ownership in some tangible parts. These are not completely unimportant for the transaction, so they count, and so it's a delivery under 3.1, and additionally 3.4 also says the same and confirms this. Because every transaction during which the position of an owner changes with regard to a tangible asset is automatically classified as a delivery. The place of delivery, if there is no movement, 3.7, and the place is Brussels, so taxable in Brussels under 3.7, 3.1, and 1.1 number 1 USDG. A tax exemption cannot be found, especially not if we take that view that there is no movement, especially then no intra-community delivery, because the parts which are fixed to the machine do not leave the country as such. I'm not sure, I don't know any court case on highest level where that has been decided by the European Court of Justice. However, I think that view is preferable. So it's liable to tax. The tax base would be the net amount. Let's say this is 30,000 here, evidently, because the supplier wants to charge this 30,000 as a tax base for an inter-community delivery, which he thinks it is. So this is evidently the net amount agreed upon. If it were a gross amount, then the tax base would be 30,000 minus Belgian tax. Tax rate and tax dependent on the Belgian tax rate for these parts. Formalities, all according to Belgian law. Taxpayer is naturally the entrepreneur, so the Belgian one. There should be an invoice confirming the VAT amount contained in the price. However, if the Belgian makes a mistake and only charges the net price, then the customer will probably not complain until the Belgian guy sees his error and tries to correct the invoice and demand the missing VAT amount as part of the price. No peculiarities which come to our minds, and if later I gets a correct invoice from B, then he can reclaim input tax from the Belgian tax authorities, because then he has an invoice for Belgian VAT is confirmed as input tax. Yeah, what else? Event number 3, selling the machine, finally the finished one, to the Spanish customer. Persons involved is I from Ingolstadt sells it, and C for customer from Spain. The movement of the good is from Brussels in Belgium to Spain. The movement begins in Brussels only because the good which the customer has ordered does not exist before the place of Brussels. So there is the old rule, you can't move a good before it exists. And that means as our finished good only exists at Brussels, this is the first place where movement to the customer can begin. So that means Brussels to Spain, that is an intra-community operation, intra-community delivery, and intra-community acquisition, because on both sides we have entrepreneurs involved. The treatment for the supplier is taxability, number 1. It's a delivery again, 3.6. The place is Brussels, so it's taxable in Belgium. Tax exemption, intra-community delivery shall be tested. Number 1, fulfilled, goes to another member state. Number 2, fulfilled, customer is an entrepreneur, because who buys a production machine is probably not a private customer. Number 3, the buyer will be subject to acquisition tax in another member state, yes, in Spain. And number 4, we can also reasonably assume that the customer, if he or she is not a complete idiot, also used his VAT identification number during the process. So it's an inter-community delivery. So it will be tax-free if the supplier handed in the recapitulative statement on that transaction correctly to the fiscal office in Belgium. Tax base is a net amount here 250,000. And yeah, now let's have a look. Tax rate and tax nothing. Taxpayers who has to hand in the tax declaration in Belgium, 13A, number 1, and formal aspects, peculiarities, none, and so on. And now everything together to make it brutal and simple. The tax base, the taxability for the customer is number 5. We have intra-community acquisition 1A1. Number 1, 2, 3, all fulfilled. It is an intra-community acquisition. The place of the acquisition is determined according to 3D. So where the planned transport ends, that's Spain. number 5, taxable in Spain. No exemption under 4B this time, so liable to tax in Spain. Tax base is the net amount 250. The tax rate and the tax depend on Spanish tax rate for production machines. Taxpayer is the Spanish buyer. Rest of formalities is all Spanish law. Input tax is possible under 15.1 number 3, or, yeah, to be precise, under the Spanish parallel to this rule, as always. We have seen in this case and the other ones, when we speculate about the law in other member states of the EU, we just cite the German rules by analogy. That depends on the proven fact that there is the VAT directive of the EU, and that 90 to 99% of the VAT legislation in all member states of the EU is identical, so that we know that perhaps the rules have different numbers and different wordings, but will be mostly identical in all other member states. So That is the reason why you usually can work on that assumption that you can use German rules also to prognosticize what will be going on in other member states. Good. Now that was everything for this case, and so we arrived at an end already, or finally for this case, and so it's time to say goodbye for today. Thank you for watching. Hope to see you again soon on this channel. And don't forget to recommend this channel to people whom you like, or even more to people whom you don't like, just depending on your preferences. My suggestion is just recommend it to both categories of acquaintances. Goodbye and till next time.